In what was arguably the most dramatic day on Wall Street so far this year, a rout in bank stocks Monday weighed on markets as investors worried about contagion from the Silicon Valley bank collapse. But you might not be able to tell by the closing numbers of the main indexes. The Dow dropped just under 0.33%, the S&P 500 shed over 0.1%, while the Nasdaq gained nearly 0.5%, as some sectors benefited from hopes the Federal Reserve could ease up on interest rate hikes. SVB's sudden failure on Friday, as well as Signature Bank, which was shut down by regulators Sunday, had investors worried about risks to other banks, despite extraordinary efforts by the U.S. government to protect depositors. First Republic Bank fell a whopping 62% as news of fresh financing failed to reassure investors. Western Alliance plummeted 47%, and PacWest dropped 21%. Trading in the stocks was halted several times. And shares of big banks, including J.P. Morgan Chase, Citigroup, and Wells Fargo, also all lost ground. A silver lining to the crisis? Many investors speculated the central bank could now become less hawkish in its efforts to tame inflation. But Sean O'Hara, president of Pacer ETF's distributors, doesn't necessarily agree.
I would have to go with what they've been saying, which is they're going to continue to raise rates until they can tamp down inflation, and that job's not even close to being done yet. Maybe they'll change tune and use this as the excuse to sort of chicken out. I don't know. And so that leads us to the big question about whether we will or we won't have a recession, and if we do, how big of a recession is it going to be?
Outside the banking industry, Pfizer shares rose after the drug maker said it would buy biotech company Seagen for nearly $43 billion.
Germany is among nations scrambling to react to the collapse of US lender Silicon Valley Bank. On Monday, the country's financial markets regulator said it was imposing a moratorium on the bank's branch there. BaFin said the situation posed no threat to financial stability. But that didn't do much to reassure investors, with European bank stocks tumbling. Jochen Stanzel is chief markets analyst at CMC Markets.
There is a huge amount of uncertainty around because there is the fear of a contagion effect, that what happened at SVB could happen at large banks. That's the reason for the losses for bank shares. At the same time, investors may think that the timing is not bad to take profits after the DAX rose 30% since October.
Over the weekend, US authorities moved swiftly to reassure SVB depositors, saying it would guarantee access to their money. But the collapse of the bank has sparked fears for the health of the sector worldwide. US bank stocks tumbled as much as 7% in early trade Monday, and Germany hasn't been spared either. By early afternoon in Europe, Deutsche Bank shares were down over 5%. Other lenders also tumbled, driving Europe's Stock 600 index to losses of over 2%.